Imagine a time when Wall Street thought technical analysis was pure magic. Crazy, right? But that's exactly how it was just a few decades ago. Today we're diving into the fascinating shift from fundamental to technical analysis, a story of how traders went from crunching numbers to reading the market's mind. Stick around, because by the end of this video, you'll see why this shift changed the game forever. This is Chapter 1 of Master the Market with Confidence, Discipline, and a Winning Attitude, a book that breaks down the tools traders use to succeed. And today we're exploring the age-old debate, fundamental, technical, or mental analysis? Let's start with the OG fundamental analysis. Back in the day, fundamental analysis was the gold standard. Traders would analyze everything, interest rates, balance sheets, even weather patterns, to predict where prices should go. Sounds logical, right? But here's the catch. These models didn't account for one critical factor: people. You see, prices aren't moved by math alone. They're moved by traders, real people with emotions, biases, and sometimes irrational behavior. Imagine this. A trader on the floor of a futures exchange makes a split-second decision based on gut feeling, completely ignoring the logical predictions of a fundamental model. That's why, even if a fundamental analysis is correct in the long run, the short-term volatility can wipe you out before you see any profits. Enter technical analysis, the underdog that became the hero. Unlike fundamental analysis, technical analysis doesn't try to predict what should happen. Instead, it focuses on what is happening right now, based on historical patterns. Think of it like this. If the market is a person, technical analysis is learning their habits, quirks, and tells. Here's the secret sauce. Traders, as a group, tend to repeat the same behaviors. These patterns are observable, quantifiable, and most importantly, predictable. Technical analysis organizes these patterns into a system that helps traders anticipate what's likely to happen next. For example, if a stock has consistently bounced back after hitting a certain price level, technical analysts see that as a signal to buy. It's not about what the company's balance sheet says. It's about how the market is behaving in that moment. And here's the kicker. These patterns repeat across all time frames, whether you're trading minute by minute or year by year. That's why technical analysis opens up a world of opportunities, no matter your trading style. So why did the trading world shift from fundamental to technical analysis? It all boils down to one word: results. Technical analysis closes the gap between what should happen and what is happening. It keeps traders grounded in reality, while fundamental analysis often leaves them stuck in a reality gap. In other words, technical analysis doesn't just help you predict the future, it helps you act on it. Ever felt like you've got the market figured out only to watch your profits slip away? You're not alone. Today we're diving into the real secret behind trading success. It's not just about charts or numbers, it's about mastering your mind. Stick around, because by the end of this video you'll understand why the best traders think differently and how you can too. Here's a scenario you might relate to. You look at a chart and it's obvious. The market is going up. You think, this is it, I'm going to make a killing. But instead of acting, you hesitate. You watch the market move, and by the time you finally decide to jump in, it's too late. Sound familiar? This is what the author calls the psychological gap, the difference between knowing what to do and actually doing it. It's the reason why so many traders struggle, even when they understand the markets. The problem isn't the market, it's how we think about the market. So what separates the consistent winners from everyone else? It's not intelligence, better analysis, or even harder work. In fact, some of the smartest people, doctors, lawyers, CEOs, are among the worst traders. The difference lies in their mindset. The best traders have developed a unique set of attitudes that allow them to stay disciplined, focused, and confident, even in the face of uncertainty. They've learned to accept risk, not just take it. This means they can enter and exit trades without hesitation, even when things don't go as planned. For everyone else, fear of being wrong, fear of losing money, dictates their decisions, and that fear creates a cycle of hesitation, missed opportunities, and costly mistakes. Here's the paradox of trading. Every trade has an uncertain outcome. No matter how much you analyze, you can never predict every possible way the market can move. And that uncertainty triggers fear. But the best traders don't fight this reality. They embrace it. They've learned to think differently. They see the market as a source of information, not pain. They don't avoid risk. They accept it fully. And that acceptance gives them the mental flexibility to act decisively without hesitation or emotional conflict. According to the author, most trading errors stem from 4 primary fears. 1. Fear of being wrong. 2. Fear of losing money. 3. Fear of missing out. 4. Fear of leaving money on the table. These fears distort your perception of the market, they narrow your focus, block out other possibilities, and lead to poor decisions. The solution? Develop a mindset that eliminates these fears by fully accepting the risks of trading. So, how do you develop this mindset? It starts with redefining your relationship with risk. Instead of seeing risk as something to avoid, you need to see it as an inherent part of trading. When you truly accept that every trade could go wrong, you free yourself from fear. This doesn't mean you become reckless. On the contrary, the best traders have a framework that keeps them disciplined. They trust themselves to act in their own best interests, no matter what the market does, and that trust is the foundation of consistent success. Let's recap what we've learned. Fundamental analysis focuses on predicting prices based on external factors, but it often fails to account for human behavior. Technical analysis studies market patterns to predict future movements, making it more adaptable and reliable. The shift from fundamental to technical analysis happened because it's easier to make consistent profits by understanding market behavior than by relying on theoretical models. Whether you're a seasoned trader or just starting out, understanding this evolution can help you make smarter, more informed decisions. Here's the bottom line. Trading isn't just about analyzing the market, it's about analyzing yourself. The best traders aren't smarter or better analysts, they've simply learned to think differently. They've mastered their mindset, and that's what sets them apart. So, what's your take? Do you lean more toward fundamental or technical analysis? Let me know in the comments below. If you're ready to take your trading to the next level, start by examining your own attitudes and beliefs. And if you found this breakdown helpful, don't forget to like, subscribe, and hit that notification bell for more insights into mastering the market. Thanks for watching, and I'll see you in the next video.